Imagine waking up one morning and realizing the economy didn't break overnight. It rotted slowly while everyone was celebrating. That's the uncomfortable truth behind the Great Depression. It wasn't caused by one bad day on Wall Street. It wasn't just greed, and it definitely wasn't random. It was a system built to reward optimism, leverage, and blind belief, right up until it punished everyone who trusted it. And once you see how it actually started, you'll notice patterns that feel disturbingly familiar today. If you've ever wondered how an entire economy can look healthy on the surface while quietly setting itself up for disaster, you're in the right place. This is Capital Misfires. Let's rewind to 1918. World War I had just ended, American soldiers came home victorious, factories shifted from weapons to consumer goods, women who had entered the workforce during the war stayed longer than expected. The result? A powerful post-war economic surge. Wages rose, production exploded, and confidence turned into culture. By the early 20s, the United States wasn't just recovering, it was celebrating. Nowhere was this transformation clearer than in Detroit. Henry Ford didn't just build cars, he changed how the world produced everything. With the moving assembly line, the price of the Model T collapsed from $780 in 1910 to $290 by 1924. By 1927, over 15 million cars had rolled off Ford's lines. Transportation became accessible, mobility became normal, and mass production became the standard. Other industries followed fast. Radios, washing machines, vacuum cleaners, efficiency lowered prices, and advertising, powered by radio, created desire. America didn't just want products, it wanted more. Here's where the system quietly shifted. To keep demand rising, banks loosened standards. People no longer needed the money up front, they just needed confidence. Installment plans, personal loans, credit for households that had never borrowed before. Consumerism stopped being about affordability and started being about access. Culturally, it matched the mood. Jazz clubs, lavish parties, a sense that old rules no longer applied. Prohibition technically existed, but enforcement barely mattered. Wall Street became glamorous. Investing became dinner table conversation. From 1921 to 1929, the U.S. stock market increased six-fold. To most Americans, this felt like proof that the system worked. As prices climbed, participation exploded. People poured in savings, then borrowed to invest, then borrowed more as prices kept rising. This is the moment every bubble shares, when people stop asking what something is worth and start believing it can only go up. By 1929, nearly 40% of consumer credit in the U.S. was being used to buy stocks, not factories, not homes, stocks. This wasn't stupidity, it was incentive alignment. Easy credit, rising prices, social proof everywhere you looked. And when a system rewards risk-taking long enough, risk starts to feel responsible. If this early stage already feels uncomfortably familiar, stick with me, because what broke the economy wasn't the crash itself, it was what came after. By the mid-1920s, something important had changed, but almost nobody noticed. On the surface, prices were rising, stock charts looked unstoppable, new highs became routine. Underneath, the real economy was already slowing. American factories were producing more than the world could absorb. Europe was still recovering from World War I. Many countries were buried in debt. Global demand for American goods weakened. Inventories piled up. Corporate profits flattened, but stock prices kept climbing anyway. This was the first major disconnect, financial markets moving up while fundamentals stalled. And instead of caution, the response was leverage. Wall Street made speculation easier than ever. Investors didn't need full cash anymore. They could buy stocks by putting down as little as 10 to 40% of the price. The rest? Borrowed. The logic felt airtight. If prices keep rising, the loan pays for itself. If they don't, well, that problem belonged to the future. This turned the stock market into a machine fueled by debt. Rising prices attracted new buyers. New buyers pushed prices higher. Higher prices justified more borrowing. A perfect feedback loop. Politically, confidence reached its peak. In 1929, newly elected President Herbert Hoover declared that America was closer to eliminating poverty than ever before. To the public, the message matched what they saw: stocks rising, credit flowing, spending everywhere. Few stopped to ask whether any of it was sustainable. On October 24th, later called Black Thursday, the illusion fractured. A record 12.9 million shares were dumped in a single day. The market fell 11%. Panic set in. Banks tried to stabilize prices temporarily. Confidence briefly returned, but the damage was already done. 5 days later came Black Tuesday, another record, 16.4 million shares sold. Markets dropped another 12%. Within 2 weeks, stock values had fallen by nearly a third. The crash didn't just erase paper wealth, it exposed leverage. Investors who bought on margin were forced to sell. Banks demanded repayment. Loans couldn't be covered. Life savings vanished overnight. But here's the key point most people miss. The stock market crash alone did not cause the Great Depression. It triggered the downturn, but the real collapse came from the banking system. In the 1920s, most U.S. banks were small and independent. They weren't diversified. They weren't regulated heavily, and many had lent aggressively into speculation. When stock prices collapsed, these banks collapsed with them. There was no deposit insurance. If a bank failed, depositors lost everything. As headlines spread, panic followed. People rushed to withdraw cash, not just from weak banks, but from healthy ones too. This is how fear breaks systems. One rumor in New York triggered a massive run on the Bank of the United States. By the end of a single day, $3 million was withdrawn. The bank closed. It failed to secure emergency funding and ultimately collapsed. That single institution accounted for 1/3 of the $550 million lost in deposits during the Depression. At this point, the economy wasn't failing because people were irrational. It was failing because trust vanished and the system had no shock absorbers. After the panic of 1929, there was still a chance to stop the bleeding. Recessions had happened before. Markets had crashed before. America had recovered before. This one didn't have to last 10 years, but the system responded in exactly the wrong ways. As banks failed, money literally disappeared from the economy. Between 1929 and 1933, over 9,000 banks collapsed. Roughly $7 billion in deposits were wiped out. The U.S. money supply shrank by nearly 30%. That contraction mattered more than the crash itself. Less money meant less lending, less spending, less hiring. Businesses didn't cut because they wanted to. They cut because cash stopped flowing. This was the moment the Federal Reserve was supposed to act. Instead, it did almost nothing. The Fed allowed banks to fail. It didn't inject liquidity. It didn't stabilize credit markets. Why? Because at the time, policymakers believed recessions were self-correcting. Pain, they thought, would cleanse excess, so they let the system burn. By 1933, industrial production fell by 46%. Corporate profits collapsed over 75%. Unemployment reached 25%, 1 in 4 workers. This wasn't a correction anymore. It was an economic freefall. Then came the Smoot-Hawley Tariff Act of 1930. The idea was simple: protect American jobs by taxing foreign goods. The result was catastrophic. The U.S. raised tariffs on over 20,000 imported products. Other countries retaliated immediately. Global trade collapsed by nearly 2/3. Exports died, factories shut down. Farmers, already drowning in debt, were crushed. Instead of isolating the damage, the U.S. exported it worldwide. What could have been a domestic recession became a global depression. Prices didn't just fall, they kept falling. Between 1929 and 1933, consumer prices dropped about 25%. Wages fell, but debts didn't. Real debt burdens increased every year. This is deflation's trap. When prices fall, consumers delay spending, businesses delay investment, and cash becomes more valuable than activity. The economy freezes, and the more it freezes, the worse the deflation gets. By the early 1930s, over 2 million people were homeless. Bread lines stretched for blocks. Soup kitchens became permanent infrastructure. Farmers lost land. Veterans protested unpaid bonuses. Entire families lived in cars and tents. This wasn't an abstract economics anymore. It was daily survival. The Depression wasn't prolonged by one mistake, but a chain of them. Tight money during collapse, bank failures without insurance, trade wars during contraction, a refusal to act decisively. Each decision amplified the last. The system didn't fail all at once. It failed step by step, while leaders insisted patience would fix it. Change didn't come until 1933, not because markets healed themselves, but because the rules finally changed. Banks were closed, deposit insurance was created, government spending replaced vanished demand, but by then, the damage was already historic. The Great Depression wasn't inevitable, it was engineered by optimism, leverage, fear, and delay. By 1933, America was exhausted. 4 years of collapse had stripped the system down to bone. Banks were closed, factories were silent, confidence was gone. This is where most stories say the Depression ended. They're wrong. It's where the response finally changed. When Franklin D. Roosevelt took office in March 1933, the economy wasn't sick, it was failing. So the administration stopped treating the crisis like a moral lesson and started treating it like a mechanical breakdown. The first move was blunt: a nationwide bank holiday. All banks closed for 4 days. Only solvent institutions were allowed to reopen. This single act did something years of speeches couldn't. It stopped the panic. Depositors came back. Withdrawals slowed. Confidence stabilized. Not because people trusted markets, but because rules changed. Next came structural reform. In 1933, SDIC was created. Deposits up to $2,500 were insured, about $55,000 today. Glass-Steagall separated commercial and investment banking. This mattered more than stimulus. For the first time, savings weren't a gamble. Bank runs collapsed almost overnight. The system stopped eating itself. Private investment was dead. Consumers were broke. Waiting for markets to self-correct wasn't an option, so the government became the spender of last resort. Between 1933 and 1939, federal spending nearly tripled. Millions were employed through public works. Roads, bridges, dams, and power grids were built. Programs like WPA, CCC, and TVA weren't just relief. They injected income directly into households, where demand actually starts. Here's the part usually skipped. The economy improved, then stalled, then fell again. By 1937, unemployment was still around 14%. Industrial output hadn't fully recovered. Government pulled back spending too early. The result? Another sharp recession inside the Depression. This wasn't theory, it was proof. Remove support too soon, and the system collapses again. Despite the New Deal, full recovery didn't arrive in the 1930s. It arrived in the 1940s. World War II forced massive, sustained government spending. By 1943, unemployment fell below 2%. Industrial output doubled from 1939 levels. Household incomes surged. The Depression didn't end because markets healed themselves. It ended because demand was rebuilt at scale. The lesson wasn't government saved the economy, and it wasn't markets always fix themselves. It was this: when private systems collapse, someone has to replace demand or the damage compounds. Delay costs years. Ideology costs livelihoods. Confidence doesn't return on its own. Every modern crisis echoes this pattern: excess leverage, asset bubbles, systemic fragility, delayed response, and premature optimism. The names change, the math doesn't. The Great Depression didn't end with a speech, it didn't end with patience, it ended when denial stopped. Let me leave you with this. The Great Depression didn't begin with panic. It began with confidence. Confidence that prices justified themselves. Confidence that debt was manageable. Confidence that risk had been engineered away. And when reality finally disagreed, the damage wasn't gradual, it was immediate. History doesn't repeat because people forget facts. It repeats because incentives don't change. Every era believes this time is different. Every bubble believes it's rational. Every collapse looks obvious in hindsight. The real lesson of the Great Depression isn't fear, it's clarity. Clarity about leverage, clarity about fragility, clarity about the difference between growth and resilience. Because wealth isn't how high you climb when conditions are perfect, it's how well you survive when they're not. If this breakdown helped you see the system more clearly, click like. It tells the algorithm this history still matters. Subscribe to Capital Misfires if you want more stories about money, power, and the systems that quietly shape your life. I'm Jimmy. This is Capital Misfires, and now you know why capital doesn't fail by accident, it fails by structure.